make it is just a listing of all these balances. You see, all
Yes.
all these balances in a very nice chronological order. That's it.
Okay, understood then.
Right? So
No
many
question.
students, they are confused about these adjustments. It's up to you. If you want to write it down, write it down. Otherwise, these figures are coming from the closing balances after the adjustments. So some accounts have adjustments, some accounts don't have adjustments. So here you see the cash account, it doesn't have any adjustments, so we just write it down here. That's it. Account receivable, it did have adjustment, right? It means previously the balance was 2200. So due to this, some customer paid back or didn't pay, it's accrued revenue, so we increase, right? So that's why the value is increased. So previously the account shows 2200 balance, and now, so this, in my point of view, no need to make this column. Okay, you can just write it down, the adjusted trial balance. First you make the trial balance, and then you make adjusted trial balance. It is just, you concise it. The two trial balance, you concise it. First the normal trial balance, and then the adjusted trial balance. It's up to you. Either you make two, two tables, or either you make one combining the two. It's up to you. Okay, let's move forward. So we have illustration here. So let's do that. Number one, we have phonics equipment rentals, which face the following situation here. So generalize the adjusting entry. It means the entry is going to fall in the four categories: accrued expenses, right? Accrued revenue, or unearned revenue, or prepaid, right? So let's just talk about it. So business has interest expense 1200 that it must pay in early January 2015, right? So you see here the company closing year is 31st December. But expense occurred? Yes. Did they pay for expense? No. They will pay later on, early January, maybe 5th of January, maybe 7th of January, maybe 10th of January. The question is not mentioned. So what will be the entry? What will be its logic behind that? Expense occurred, so that expense belonged to 2014, not 15. So expense is going to be recorded in 2014. So this belongs to the income statement of 2014, right? Matching principle. If expense belongs to 2014, it will be recorded in 2014. Maybe paid later, we don't care, but recorded in 2014. So expense occurred. Did you pay the expense? No. It means you create liability. Rules are there for entry. Debit. First debit is recorded, then credit is recorded, right? So what would be the entry? Expense to payable. Expense increase debit, liability increase credit. And how you pronounce this entry? Interest expense to interest payable. Right, guys? If you don't understand, please, you can stop me here. You can just tell me that, please, repeat that.
Which account is interest payable?
Payable is liability.
So it's on the credit balance, right? If I do the T account, it's the credit side, right?
So what are the rules for credit? For liability? Liability increase, credit. So we increase the liability, right? 1200. It's credit.
Okay.
Right?
Just.
And now, so again, first, for adjusting entries, pay very close attention to closing dates. or closing fiscal years or accounting year. So closing date is 31st of December 2014. And now the unadjusted balance of the supply accounts for 3,200, which means in our balance sheet account shows that we have supplies worth of $3,200. So the total cost of supplies on hand, which means at the end of the year, December 31st, we have $1,500 worth of supply. So how much we have used, how much paper, pencil, rubber, printers, ink, what we have used, how much? So we had at the start of the year 3,200.
We do minus.
And we have 1,500 left. So how much we have consumed? We need to find this. So 3,200 minus 1,500. Answer is 1,700, right? So it means 1,700 we have used. When we have used it, so that becomes our expense, right? And now we record the expense. Out of 3,200, 1,700 is expensed. We use that in 2014. So we expense it. So expense increase 1,700, supplies decrease 1,700. So what would be the entry? Expense increase, debit or credit? Fabian.
Credit.
Expense increase. Floy.
You say expense? Yeah, credit. Expense is liability.
Credit.
Anis.
It's credit.
Credit.
Expense increase. Guys, you need to watch carefully about our lectures, I think 2 weeks ago. Because if you are not clear about the rules, you cannot move forward. All the future discussion and today's discussion based on the rules. Very simple rules. You can just take a picture in your mobile phone and you can just look, multiple times or several times, and it should be in your mind that, okay, expense increase, debit, right? Sales increase or revenue increase, credit. Asset increase.
Because expenses liabilities, yes?
Expenses are not liability.
So why is it increased for debit?
Expenses are not liability. So we have supplies that are consumed. 1,700 we consume and we transfer it into expense. So supplies are our assets, supply, expense is going on over here.
Yeah. Okay.
So you must understand the rules of debit credit, right? So let me write it down here to refresh your memory, so that at least in our next coming slides, you have some kind of idea what's going on. Otherwise, you will be point blank what's going on. And this really made me sad. That you don't know about the rules yet. So what is the accounting equation? Assets is equal to liabilities plus honors
Equity.
Right? And honors equity also includes
stock
or revenue,
order.
And also expenses. Income statement also belongs to honors equity because profit and loss belongs to honors equity, not the liability holders. The categories of honors equity are common stock and retained earning. Okay, so we talked about that. If assets increase, we call it debit. If asset decrease, we call it credit. When we journalize the entry, Asset increase, debit. Asset decrease, credit. So what are the assets? We have two kinds of assets, current assets and fixed assets or long-term assets, right? Liabilities include current liabilities and long-term liability. So for liability and owner's equity, if liability increase, credit. If liability decrease, debit. Similarly with the owner's equity, if owner's equity increase, owner's equity increase,
it's credit.
yes. So owner's equity increase is credit. It decrease, it's debit. So there is one exception, that is expense, because when expense increase, it decreases the owner's equity. The relationship between owner equity. Let me just. The relationship between expenses. Here I need to write it down. Amazing. Let me clear all this trying here. So the relationship between expenses and owner equity is negative, which means if expense increase, owner's equity decreases, right? So if an expense increase, so it is called if expense increase, it is called decrease in owner equity. Decrease in owner equity means
Debit.
debit. So that's why if expense increase, it is debit. If expense decrease, it is credit.
Credit.
Right? So remember that one. Similarly with the sales or revenue, if revenue increase, it increases the owner's equity. That's why it is credited.
Credit.
Yeah, well done. So let's go back to our illustration here. So now, again, let me read this illustration here. The unadjusted balance of the supplies account, 3,200. A total cost of the supplies on hand, 1,500. So it means when at the start of the year we have 3,200, right? What we have now on hand, 5,200. So how much we have consumed or how much is used? 1,700, right? So you just find out, solve the equation, it would be 1,700, right? So 1,700 must be decreased from this supply account. Supply account is our